Welcome back to Financial Crux, and today's breakdown might honestly be the most critical data analysis I've ever shared on this channel. I'm not saying that lightly. What we're about to walk through is not just another market update, not another short-term price prediction, and definitely not clickbait. What's unfolding in the silver market right now is historic. The numbers coming out of the futures exchanges, vault reports, and global inventory data aren't just unusual. They point to a structural shift. And if you truly understand what those numbers imply, you also understand why the entire pricing mechanism for silver could be on the verge of breaking. Right now, the situation is brutally simple. Roughly 400 million ounces of silver are claimed on paper contracts, and only around 100 million ounces are actually available for delivery. That is the imbalance staring directly at the COMEX system. Demand stacked against supply in a way that simply cannot coexist forever. Because eventually, someone asks for the metal. And when that happens, paper promises don't satisfy industrial users, investment funds, or sovereign buyers. Only real metal does. If you believe that 4 times more claims than available metal can continue indefinitely without consequences, then I have a warehouse full of imaginary silver contracts I'd love to sell you. But before we dive deeper into the data, let me ask you something. Where are you watching from right now? Drop your location in the comments. United States, Canada, the UK, Germany, Australia, India, Singapore. Wherever you are, let me know. One of the most fascinating things about this channel is seeing how global this community has become. Because what's happening in silver isn't local. It's global. This isn't just a North American story or a European story. The pressure building in precious metals markets is worldwide, and I want to see how far this community stretches across the planet. So comment below, and let's see where everyone is tuning in from. Now, let's get into the numbers, because February 2026 is shaping up to be a month that market historians may look back on as the beginning of something massive. In just the first few trading days of February, nearly 19 million ounces of silver have already been taken for physical delivery on COMEX. Let me repeat that slowly. 19 million ounces in only a few days. To put that into perspective, that's almost the entire delivery volume we saw during the whole month of February last year, compressed into less than a single week. That is not normal. And what makes this even more extraordinary is how those deliveries happened. Roughly 98% of open contracts stood for delivery, not rolled forward, not settled in cash, not postponed into future months. Actual physical delivery. Buyers didn't want exposure anymore. They wanted ownership. And this is what markets look like when trust begins to erode. When participants stop believing that paper claims are enough. When investors convert contracts into metal because they're no longer comfortable relying on promises. For decades, the silver market functioned because most traders never intended to take delivery. Contracts were rolled forward endlessly, and the system worked as long as people stayed inside the paper game. But when buyers start asking for real metal, the illusion of endless supply starts to crack. And that's exactly what we're seeing now. I've followed the silver market closely on this channel for a long time, and one warning has come up repeatedly. The divergence between paper silver and physical silver could not last forever. Paper claims stacked on top of each other. Multiple ownership layers built on the same underlying ounces. Contracts multiplying far faster than actual metal supply. That structure always had an expiration date. And the delivery data coming in right now suggests that expiration date might be approaching faster than most people expected. Which brings us to March 2026. Because March could be the month everything comes to a head. Current open interest for March contracts sits around 80,500 contracts. And each one represents 5,000 ounces of silver. Run the math. That's over 400 million ounces claimed on paper. And how much silver does COMEX actually have ready for delivery? About 103 million ounces. So we're looking at roughly 4 ounces promised for every 1 ounce available. This isn't conspiracy theory territory. It's basic arithmetic anyone with a calculator can confirm. The real question becomes, what happens when buyers actually demand delivery? What happens when industrial manufacturers that need silver for electronics, solar panels, and advanced systems say, ship the metal? What happens when funds managing real assets say they want physical holdings? What happens when sovereign entities diversifying away from paper currencies request delivery? That's when the mask comes off. And based on what we're seeing in February, That moment may be closer than anyone realizes. Let me ask you something here. How long have you personally been following the silver market? Are you someone who's been stacking for years, quietly accumulating physical metal? Or are you newer, trying to understand why precious metals are suddenly back in focus? Drop a comment and let me know. Understanding where viewers are in their journey helps shape the content we build here, because education matters more than hype. Now, zooming out, this pressure isn't limited to comics alone. The global silver supply picture is tightening everywhere. In China, combined inventories across major vault systems have fallen to levels showing less than 30 million ounces of visible silver remaining. Think about that. China is simultaneously the world's largest solar panel producer, aggressively expanding electric vehicle manufacturing, and rapidly building out AI and advanced technology infrastructure. And they are buying silver aggressively. Metal is flowing eastward, from Western vault systems toward Asian demand centers, faster than many Western markets can react. For decades, precious metals slowly migrated east. Now it looks more like a drain. Silver leaving Western vaults and moving into long-term holders who are unlikely to sell back into markets anytime soon. Meanwhile, the LBMA estimates that globally available, uncommitted silver, what traders call the free float, sits around 150 million ounces. Sounds large until you compare it to consumption. Global industrial demand alone burns through roughly 75 million ounces every month, meaning the freely available silver supply equals about 2 months of industrial usage. That's not a comfortable cushion. That's a fuse. And before we continue, let me mention something quickly. Around 70% of people watching this channel aren't subscribed yet. If this analysis helps you understand what's really happening beneath market headlines, consider subscribing. It costs nothing, but it helps this channel continue producing independent market breakdowns like this. Also, our WhatsApp and X communities post updates when major developments hit markets in real time. So check those links in the description if you want faster updates. Now, let's move into one of the most overlooked indicators in precious metals markets: silver lease rates. Most retail investors never look at lease rates, but professionals watch them closely because they reveal stress in the physical market. Lease rates represent what it costs institutions to borrow physical silver. When supply is abundant, borrowing costs stay low. But when metal becomes scarce, borrowing costs spike. And right now, lease rates have surged above 6%, the highest level seen in years, which tells us something critical. Banks and bullion dealers, institutions assumed to have access to large inventories, are suddenly paying higher rates just to borrow silver. That means physical supply is tight, and tight supply leads to pressure. Pressure leads to margin stress, and margin stress historically ends with short squeezes. This is often the warning signal that appears before explosive price moves begin, the kind of moves that rewrite charts and catch algorithms off guard. And this time, the stakes are larger, because it isn't just traders on the other side. It's the entire paper money system. And increasingly, physical holders are the ones gaining leverage. Let me pause again and ask, what was your reaction when you first saw the February delivery numbers? Did they surprise you? Confirm your expectations? Or do you remain skeptical about their importance? I read the comments, and the discussion here adds real value to this community. Now, let's talk about price action, because volatility has been extreme. As of February 2026, silver trades near $82 per ounce, rebounding after one of the wildest months in modern silver history. Late January saw prices spike near $120 before collapsing nearly 50% as leverage unwound across markets. And that kind of move shakes confidence. Watching price drop from triple digits into the 60s in days is psychologically brutal, even for long-term believers. But understanding what caused that crash matters. But understanding what really caused that crash is critical, because most people misunderstood what actually happened. When silver exploded toward $120 in late January, it wasn't just organic demand pushing prices higher. A massive amount of leverage entered the market at the same time. Traders borrowed aggressively, piling into futures contracts expecting prices to keep climbing. Leverage stacked on top of leverage. Speculation piled onto momentum. And for a short period, prices ran ahead of what the physical market could realistically support. That made the rally fragile. Then came the trigger. The CME Group, which operates COMEX, began raising margin requirements. not once, but multiple times within a single week. And margin requirements matter more than most people realize. Imagine you control a silver contract worth $100,000, but you only needed to post $11,000 initially. Suddenly, the exchange says you must now post $18,000 or even $20,000 to keep the position. If you don't have the extra capital available immediately, you have only one option: sell. And when thousands of leveraged traders face margin calls simultaneously, selling cascades through the market. Positions are liquidated. Stop losses trigger more selling. Algorithms amplify the downward momentum, and prices collapse faster than fundamentals change. That's exactly what happened. But here's the critical point that many investors missed. The crash was not driven by weakening physical demand. It was driven by leveraged traders being forced out. The sell-off flushed out speculation, not fundamentals. Once the forced liquidation ended, what remained in the market were stronger hands: institutions, industrial buyers, and investors actually seeking physical exposure rather than quick paper profits. That's why silver stabilized around the $80 region afterward. This price level reflects real demand rather than borrowed money chasing momentum. And in many ways, the setup after that crash is healthier than before the rally. The excess leverage is gone. Weak hands exited. The foundation is stronger now. And for viewers who are newer here, let me clarify something important about this channel. Financial Crux does not sell signals. We do not offer paid mentorship, trading courses, or subscription services. If someone contacts you claiming to represent this channel and asks for money, it's a scam. Block them immediately. Our only platforms are YouTube and X under Financial Crux. That's it. We simply analyze publicly available data and try to interpret what it means. Because markets reward independent thinking. The moment you outsource your decisions to someone else, you become vulnerable to manipulation and hidden agendas. Now, let's step back and examine the bigger picture, supply and demand, because that ultimately determines price over time. And this is where the situation becomes even more striking. The year 2026 marks the sixth consecutive year in which global silver demand has exceeded supply. 6 straight years where the world consumed more silver than it produced. And those deficits accumulate. Global mine production currently sits around 800 million ounces annually. But total demand, combining industrial use, jewelry, silverware, and investment, runs closer to 1.3 billion ounces per year. That leaves a gap of roughly 500 million ounces every single year. 500 million ounces that must come from somewhere. Some supply comes from recycling, yes. But most of the shortfall gets filled by drawing down above-ground inventories, metal stored in vaults, warehouses, and stockpiles built over decades. And those inventories are not infinite. They're being depleted year after year. COMEX inventories confirm it. LBMA inventories confirm it. Shanghai inventories confirm it. There is no hidden silver mountain waiting to fill a 500 million ounce hole. And even if prices suddenly doubled or tripled tomorrow, new mine supply wouldn't appear quickly. Building mines takes years. Exploration, environmental approvals, construction, infrastructure. The timeline typically runs 5 to 7 years before meaningful production reaches markets. Meanwhile, demand keeps accelerating. And understanding where that demand comes from is crucial, because silver is no longer just a precious metal. It has become an industrial necessity. The single largest driver of new silver demand today is solar energy production. Modern photovoltaic cells rely on silver paste for electrical contacts because silver is the most conductive metal known. It transmits electricity more efficiently than copper. Solar installations globally are expected to reach roughly 700 to 750 gigawatts of new capacity in 2026 alone. And each gigawatt of solar capacity requires roughly 1 million ounces of silver. Do the math. That's potentially 700 million ounces of silver demand coming from solar installations alone, nearly equal to total annual mine production. Electric vehicles add another layer. EVs require significantly more silver than traditional combustion vehicles. Silver appears in battery systems, electronic control units, charging infrastructure, and high-efficiency wiring systems. As EV adoption expands globally, silver demand expands with it. But here's the demand driver almost nobody is talking about yet. Artificial intelligence infrastructure. AI data centers require enormous computational power, which generates tremendous heat. Silver's unmatched thermal conductivity makes it ideal for advanced cooling and heat management systems. It's also used in high-precision electrical contacts and switching systems that power advanced computing hardware. As AI infrastructure expands worldwide, this becomes an additional demand stream layered on top of solar and EV growth. The world is not using less silver. It's using more every year. And substitution isn't easy. No other metal matches silver's combination of electrical and thermal properties. Silver is increasingly becoming the metal behind modern technology, the metal behind energy transition, the metal behind digital infrastructure, which is why many analysts now refer to silver as the ultimate energy metal. Let me ask you something here. What originally drew you to silver? Was it the investment opportunity, industrial demand growth, monetary history, or simply diversification? Comment below. I'm genuinely curious. Now let's move to one of the most important dates approaching in this market. February 27th, first notice day for March silver contracts. And this is where futures markets move from theory to reality. First notice day forces contract holders to make decisions. Do they roll contracts forward, settle in cash, or demand physical delivery? Based on what we saw in February, where 98% stood for delivery, expectations are rising that March could see significant delivery pressure as well. Let's revisit the math. 80,500 contracts, each representing 5,000 ounces. Over 400 million ounces claimed, against just over 100 million ounces registered and available. If even 25% or 30% of those contract holders stand for delivery, the exchange simply doesn't have enough silver ready to deliver. And that's when things become unpredictable. Possible outcomes include cash settlement premiums, delivery delays, or sudden price adjustments designed to attract physical supply. And none of those scenarios would look calm. But markets rarely follow clean scripts, which is why we need to look at both sides. And in part 3, we're going to break down the bearish risks and the bullish case side by side. So before we get carried away with bullish excitement, we need to slow down and honestly examine the risks. Because markets never move in straight lines, and anyone who tells you silver can only go up from here is either inexperienced or trying to sell you something. Let's walk through the bearish scenario first. The biggest short-term risk remains margin pressure. If the exchange decides volatility is getting out of control again, the CME can raise margin requirements further. And we've already seen how powerful that tool is. Higher margins mean traders must post more capital to maintain positions. And when traders can't meet those requirements, positions get liquidated. Forced selling pushes prices down quickly, regardless of long-term fundamentals. So even if physical supply remains tight, paper markets can still experience violent corrections. Another risk comes from monetary policy. If the Federal Reserve keeps interest rates elevated or signals tighter financial conditions for longer than expected, the US dollar could remain strong. A strong dollar typically pressures commodity prices because metals become more expensive for buyers using other currencies. In that environment, speculative demand can temporarily weaken, even if long-term fundamentals stay intact. There is also the possibility of coordinated intervention. This is uncomfortable to talk about, but history shows governments and central banks will intervene when markets threaten broader financial stability. If silver volatility begins spilling into other markets or creating systemic stress, authorities could step in through regulatory or financial measures designed to calm prices. We've seen similar actions in bond markets, currency markets, and even equity markets before. Then there's economic slowdown risk. If global growth contracts sharply or we fall into a deep recession, industrial demand for silver could temporarily soften. Factories slow production. Consumer demand weakens. Manufacturing activity declines. That would reduce industrial consumption, at least in the short term. So those are real risks. Markets are complex systems, and nothing is guaranteed. Now let's look at the bullish case, because the argument on the other side is equally powerful. The delivery behavior we're seeing right now is unprecedented in modern silver markets. For decades, most futures contracts simply rolled forward, with only a small percentage demanding delivery. But now nearly all contracts are standing for physical metal. That represents a behavioral shift among market participants. Industrial buyers, investment funds, and even sovereign players appear less willing to rely on paper exposure alone. When the largest participants in a market change behavior simultaneously, major price adjustments often follow. Then we have lease rates. The surge above 6% isn't driven by retail investors or social media hype. Lease rates reflect institutional demand to borrow physical metal. Banks and bullion dealers paying higher rates to secure supply is a direct signal that metal availability is tightening at the wholesale level. This isn't emotional trading. It's professional institutions competing for scarce supply. At the same time, vault inventories continue declining globally. COMEX inventories trend lower. LBMA inventories trend lower. Asian vault systems show tightening availability as well. And the metal leaving these systems tends to move into strong hands, long-term holders who are not quick sellers. Meanwhile, the structural supply deficit continues growing. Annual mine production around 800 million ounces simply cannot keep pace with global demand exceeding 1.3 billion ounces. And demand drivers are expanding, not shrinking. Solar expansion, electric vehicles, AI infrastructure, advanced electronics, energy transition investments. All of these require silver. And unlike some commodities, silver has limited substitution options in many high-performance applications. The market doesn't fix a supply deficit at low prices. Higher prices are what encourage recycling, efficiency improvements, and eventually new mining investment. Until then, shortages accumulate. Technically speaking, the market structure has also improved after January's crash. Silver held key retracement support levels, and momentum indicators recovered from deeply oversold territory. The speculative excess was washed out. What remains now is a cleaner setup without excessive leverage weighing on prices. And we also have to consider the broader macroeconomic backdrop. Government debt levels worldwide continue rising. Fiscal deficits are expanding. Currency purchasing power continues eroding over time. And central banks themselves are accumulating gold at record pace, a signal that even monetary authorities seek hard assets. Silver often follows gold in long-term monetary cycles, but with greater volatility. So the bullish case isn't just about silver supply. It's about confidence in paper money itself slowly eroding. Silver becomes the pressure valve because it serves both industrial and monetary roles. Now, rather than making predictions, let me tell you what indicators I'm watching closely in the coming weeks. First, ongoing February delivery data. Are deliveries continuing at elevated rates, or do they slow down? Second, March open interest heading into delivery. If contracts remain high into first notice day, delivery pressure could intensify. Third, COMEX registered inventory levels. If available silver continues declining, tightness increases. Fourth, lease rates. If borrowing costs continue rising, it confirms physical scarcity. If they fall, pressure may temporarily ease. Fifth, Shanghai market premiums. Higher premiums indicate stronger Asian demand pulling metal eastward. And sixth, exchange announcements regarding margin changes. Further increases could create short-term volatility again. Let me also offer some perspective for anyone who experienced the January crash emotionally. Market corrections are designed to test conviction. Rapid price declines create fear. They shake out weak hands. They force over-leveraged traders to exit. That's how markets transfer assets from impatient participants to patient ones. If your exposure was sensible and not heavily leveraged, January was painful but survivable. And the underlying thesis for silver didn't disappear. If anything, delivery data and tightening supply strengthened the long-term argument. Investors who have quietly accumulated physical silver over years, enduring price swings, skepticism, and manipulation accusations, may finally be approaching the environment they've waited for. But remember, this isn't guaranteed profit. This is still a volatile market with real risk, and decisions should always be made based on personal financial circumstances and independent research. And that's where we'll continue in Part 4, where we wrap everything together, summarize the situation, and discuss what happens if delivery pressure truly forces the market's hand. So let's bring everything together now and look clearly at where we stand. Strip away the noise. Ignore the daily price swings. Forget the emotional reactions that markets are designed to provoke. What remains are numbers. And numbers tell a very straightforward story. March contracts represent more than 400 million ounces of silver claimed on paper. COMEX registered inventories show roughly 100 million ounces available for delivery. a 4-to-1 leverage ratio against actual vault supply. At the same time, February deliveries have already nearly matched last year's total in only the first few days of the month. And nearly every eligible contract holder is choosing delivery instead of rolling forward. That represents a historic change in behavior. Globally, vault inventories continue trending lower. LBMA estimates only around 150 million ounces remain freely available, barely enough to cover a couple months of industrial consumption. Lease rates are sitting at multi-year highs, signaling that institutions are paying up just to secure physical supply. Meanwhile, global demand continues exceeding mine production by roughly 500 million ounces per year, 6 consecutive years of deficits. And new supply cannot appear quickly even if prices rise sharply. Industrial demand keeps expanding through solar installations, electric vehicles, and now AI infrastructure buildouts. Silver is no longer simply a precious metal investment. It is embedded in modern technology and energy systems, and substitutes remain limited. On top of all that, macroeconomic conditions remain supportive for hard assets. Debt levels continue climbing. Currencies continue losing purchasing power over time. Central banks themselves continue accumulating gold as insurance against monetary instability. Silver sits at the intersection of monetary metal and industrial necessity. And that combination makes current supply stress particularly important. But here's the part that matters most. Markets don't move simply because math says they should. They move when participants change behavior. And behavior is clearly shifting. Investors are requesting delivery. Industrial users are securing supply. Institutions are seeking physical ownership. Metal is moving into strong hands rather than circulating within trading systems. Paper claims are being converted into real ounces. And when enough participants ask for reality instead of promises, the system has to adjust. Now, does this mean silver explodes tomorrow? Not necessarily. Markets rarely follow neat timelines. Volatility can continue. Corrections can still happen. Policy decisions, margin changes, or economic slowdowns could temporarily interrupt the move. But what the data suggests is that the structural pressure building beneath the market is real. And pressure, eventually, demands release. Let me ask you directly now, are you positioned for this environment? Have you been accumulating physical metal over time? Are you watching from the sidelines waiting for clearer confirmation? Or are you still skeptical that any of this ultimately matters? Drop your thoughts in the comments. The discussion here helps everyone see different perspectives. And remember something important. Never invest based solely on someone else's conviction. Not mine, not anyone's. Do your own research. Verify the numbers yourself. Look at the delivery reports. Check inventory data. Follow lease rates. Understand both risks and opportunities. Markets reward independent thinking. Blindly following anyone eventually leads to mistakes. Volatility will remain real. Uncertainty will remain real. But the numbers we walk through today are public information anyone can verify, and they point toward a system under growing strain. So let's summarize the situation one final time. Hundreds of millions of ounces claimed, only a fraction available. Record delivery requests, declining global inventories, rising lease rates, structural supply deficits, expanding industrial demand, and a monetary system increasingly dependent on debt expansion, all converging at the same moment. First notice day approaches, delivery decisions approach, and the paper market faces a simple test. Can promises still be satisfied with real metal? Or does price finally have to adjust? We'll find out soon enough. Until then, stay informed. Think independently. Manage risk carefully. And remember, markets don't reward emotion. They reward preparation. Thanks for watching, and I'll see you in the next update. TikTok.